Happy Friday, everybody. Mike Sorrentino here, and we've got a subject this week that I'm dreading even discussing. It's come back from the dead, and obviously what I'm referring to are meme stocks and GameStop and AMC and all that stuff that I thought was in the rearview mirror 3 years ago. Great quote from Keith Gill. If you don't know who that name is, watch a movie rather, called Dumb Money on Netflix. It's about the GameStop saga back in 2021. Keith Gill, or his handle known as Roaring Kitty, was one of if not the person who started the whole craziness. Some broker up in, I think, I don't even remember where it was, Massachusetts maybe, started doing these videos on GameStop, like 8-hour long YouTube videos, and created a massive story that the media latched onto. This is a quote from him when he was testifying in front of Congress. I'm not kidding. He started off by saying a few things I am not. I'm not a cat. I am not an institutional investor, nor am I a hedge fund. Said that to Congress. Okay, so this is the type of person we're dealing with. And this week he came back in a big way. If you look at GameStop's stock price on the far right-hand side, as you can see, this week on Monday, it spiked in a massive way. It was up something like 70% on Monday. On Tuesday, at one point, it was up another 110%. Come back down a little bit since then, but believe me, it's hard to know with stocks like these what's going to happen next. But the story here is that GameStop did not get acquired by Apple. Okay, GameStop did not have stellar earnings report. What caused this rally, this massive spike in the stock price, was this. Roaring Kitty has not tweeted on Twitter or X, whatever you want to call it, in 3 years. It's gone 3 years dead silent. I think his lawyers probably told him to stop doing this stuff. All he did on Monday was post this picture. Just that picture, and immediately caused GameStop to go crazy. Now, this is the crazy amount of influence from some young guy who's not an institutional investor, nor is he a cat. So what's going on here? You would think people would learn their lesson. All right, these meme stocks, how did this start in 2021? Well, it was just a couple months before 21. Basically, at the time, GameStop was one of the most heavily shorted companies out there, by far the most shorted company of its size. Now, when I say shorted or short a stock, that means there were a lot of investors out there, particularly fancy hedge funds, that were betting that GameStop's stock would fall. Now, in that instance, when you have a lot of people betting that, you can create a very strange occurrence in financial markets. So if you think about it, if you buy a stock, your risk is zero. Okay, if I buy a stock for $10, my risk is that it goes down to zero, but my risk is finite. My losses are finite. They're capped at zero. All right, so if I put in $1,000 and I lose all my 1,000, I can't lose any more. It doesn't work that way. If you flip it around, if I'm betting a stock goes to zero, then my upside is capped, okay? Because it can't go lower than zero. But what can happen is I can have unlimited risk. Because if I'm betting the stock's going to go down and it goes up, it could theoretically go to the moon. There's nothing stopping that stock from going higher. So a lot of times what will happen is there are investors out there that look for stocks that are very heavily shorted, and they'll try to coordinate their buying at the same time to cause what's called a short squeeze. Meaning if I'm short a stock, if I'm betting it's going to go to zero, and that stock starts rising in price, I'm losing money. And I got to do something about it quickly. So what will happen is that the stock price starts going up because there are buyers out there that are buying because they know a lot of people are betting against the stock. Then the stock price starts going up, and what will happen is all the people that are short the stock get scared because they have unlimited risk. So they go in and they buy the stock to close out their positions. So it creates what we call a short squeeze, where you see a massive spike in the stock price. The stock you're seeing on the screen here is Volkswagen. And this was a couple of years ago. Actually, this is longer than that. It was during the financial crisis. At one point, Volkswagen became the most valuable company in the world because of a massive, massive short squeeze that only lasts for a couple of days. This will wipe out hedge funds. It will wipe out anybody if they're not careful. GameStop took down one of the most prominent and prestigious hedge funds in the world in February of 2021 because of just like this. So what we saw this week was another short squeeze. People didn't learn their lesson. There was a lot of people shorting GameStop up until Monday. And when he tweeted this, it caused a lot of buying. And when that buying started happening, a lot of people said, oh my God, I got to get out of my short position, and it just basically threw gasoline on the flame. So that's what's going on here. It's amazing to me, though, that it's happening again. Go back to all those meme stocks in 2021, and I just put a handful of them on the screen here to show you what has happened to these stocks since then. GameStop, even with this run-up, down 87%. AMC, down 99%. Tupperware, down 97%. Bed Bath Beyond, bankrupt, gone. They're not even around anymore. How could these people be looking at this and saying, geez, this makes a lot of sense? I think what's happening here, I got to quote one of my favorite shows of all time, The Simpsons. All right, Sideshow Bob. He kept stepping on the same rake, making the same mistake over and over and over again. These people either won't learn, they're bored, they think it's funny. I don't know. All I know is that meme stocks are something that I don't touch because I can't understand them. I don't have an ability to forecast something when people are buying companies that are bankrupt or close to bankruptcy. And they're buying them because they think it's funny or because they think they can cause a short squeeze. All right. Now, I'm not saying you can't make money on this. I don't know. But this is not an investment strategy that we're going to adopt here anytime soon. If they want to continue to step on the same rake, my suggestion is sit on the sidelines, watch, and if you feel like laughing, go right ahead, because we all know how the story is going to end. I want to just be very quick, finish up here talking a little bit about the economy and what we saw this week. Inflation came in a little bit cooler than expected. That's good, but it's one data point. Remember, we got to make sure that we want to see a series of data points before we start claiming victory. We're starting to see a little bit, there's a little bit of a pricing in event going on with a potential rate cut in July. I would be shocked if we saw that. But then again, we don't invest and we don't take bets on what the Federal Reserve is going to do, because that is a game that is very difficult to do when I think even the Fed doesn't know what they're going to do by July. The probability is increasing as we go into September later on in the year. And it's hard to say exactly what happened. But my point here is that the inflation report that we saw this week was an encouraging one. That's the reason why I think we're seeing pretty much every index right now at all-time highs. The S&P 500 hit an all-time high this week. The Dow broke 40,000. Now, if you've been listening to our webinars, you know that I don't really follow the Dow. I find the index to be kind of funny. It doesn't make much sense. It's a price-weighted index. What that means is that a stock that has a higher price than another one gets a higher weighting in the index. Stock prices don't make any sense. They're arbitrary. So in this instance, you get a stock price that's $1,000 a share that could have a higher weighting than Apple, which is the largest company in the country. So that's kind of a strange index to me. But my point here is that these indexes are at all-time highs because we're starting to see a lot of optimism baked in to where interest rates are headed. That might be a bit of a disconnect because we're seeing some economic data at the same time that's not so great. 1 in 5 credit card holders has maxed out on the credit card. So there are little data points like that, which, again, it's not to say that we need to be alarmed or worried or anything like that. It's just one of those things where, remember, the market, the stock market that is, and the economy don't always move in sync. So great news in mid-May. This whole sell in May and go away. I find nursery rhymes in investing to be kind of funny. I find meme stocks to be even funnier. Stay away from them. Have a great weekend.